All right, time to really dig into Kizzy and Woch's advanced financial modeling and analysis in property investment. Have to say, you're in for a treat. This book is a gold mine. Something that really struck me, and I want to get your take on this, is how Kizzy talks about financial modeling. It's not about tossing your gut feelings out the window, right? It's about using data to make those instincts even sharper. What are your thoughts?
Yeah, that's a great point. I mean, think about it. The market doesn't reward you for flying blind, does it? This book, it really hammers home the fact that data, it's not here to replace your intuition, it's here to make it bulletproof, gives you that structure to really analyze and back up your gut feelings.
It's like that saying, measure twice, cut once, but for property, right?
Yeah.
And speaking of measuring, Kinsey gets seriously deep into cash flow, like a whole chapter dedicated to it. Why do you think he puts so much emphasis on cash flow modeling?
Because at the end of the day, cash flow, it's the lifeblood of any property investment. It can't just look good on paper. Those numbers, they have to tell a story. And that story, it's all about sustainable income. Can you cover the mortgage, the taxes, unexpected repairs, and still have money in your pocket at the end of the day? That's what cash flow analysis helps you figure out.
Makes sense. So we're not just talking about glancing at the purchase price and the potential rent. We're talking about really getting into the nitty-gritty, projecting those cash flows down the line. What were some of the things that stood out to you from Kizzy's take on cash flow modeling?
One thing that's crucial is being conservative with your estimates. Don't just assume 100% occupancy or the rosiest rental rates. Kizzy's a big advocate for factoring in things like potential vacancies, those pesky late payments, even bumping up your expense estimates a tad. It's all about having a cushion for the unexpected.
Better to be pleasantly surprised than blindsided, right?
Yeah.
He also dives into this idea of forced depreciation, which isn't something you typically associate with financial models, but it's this concept that strategic renovations can actually push your property's value up faster than the market. What are your thoughts on that?
Oh, it's a fascinating idea, and it highlights how intertwined data and action really are. You're not just analyzing a property as it is, but using the model to explore those potential improvements that could really make a difference in its value and cash flow.
It's like you're using the data to uncover those hidden opportunities, the possibilities that others might miss entirely. That's powerful stuff.
Yeah.
But what about those curveballs the market throws at you? Interest rates going up, or maybe the rental market takes a dip. That's where the what-if analysis comes in, right?
Exactly. Kizzy talks about this, the importance of sensitivity analysis and scenario modeling. These tools, they help you see how different factors, like interest rates going haywire or a sudden spike in vacancies, how those things could impact your bottom line, like a stress test for your investment.
So instead of just crossing your fingers and hoping for the best, you're actively planning for those different scenarios, saying, okay, what if things don't go exactly as planned? And then using the data to explore those possibilities.
That's the idea. And by anticipating those potential bumps in the road, you can make better decisions and really mitigate your risks.
It's like having a financial crystal ball, but instead of vague predictions, you've got data to back it up. It's like running simulations in your head, right?
Mm.
Which brings me to something else that really caught my eye in the book. Real options analysis. It sounds kind of Wall Streety, but Dickey's actually makes it pretty easy to grasp. Can you break that down for us a bit?
Sure, sure. Real options analysis, it's really about putting a value on flexibility. When you invest in a property, you're not just buying a building, you're buying the potential to make choices about that property down the line.
Okay, so say I buy an apartment building, but later on, maybe I think about converting the basement into another unit or adding a rooftop deck, something to boost that rental income.
Exactly. Those are options, and they have value even if you never actually do them. It's about understanding that potential upside, how the choices you make today, they can affect those options down the road.
Like having an ace up your sleeve. You don't have to play it, but knowing it's there, that gives you an edge. Okay, so we've got cash flow, what-if analysis, real options analysis. One more concept I got to bring up because it's huge. Time value of money. Got to admit, this one always tripped me up back in my econ classes.
Yeah, it's a fundamental in finance, but people, even seasoned investors, they often overlook it. Basically, time value of money means a dollar in hand today is worth more than a dollar you get tomorrow.
Because that dollar today, you can invest it, right? It earns interest, it grows over time. That future dollar, it's still just a single dollar.
Exactly. And this concept, it's critical when you're evaluating properties. Kizzy breaks down how to calculate the present value of those future cash flows. Basically, what are those future earnings really worth to you in today's dollars?
So let's say I'm looking at a property and the projections show a certain cash flow over 5 years. I can use this time value of money to see what that whole income stream is actually worth to me right now.
Right on. It's like peering into the future of your investment and understanding how much those earnings are worth in today's money. Helps you compare different investment opportunities more effectively.
That's incredibly useful. It's not just about projecting that income, but making sure it justifies the investment you're making today. We've covered a lot, but there's one more thing from the book that really resonated with me, and that's the emphasis on taxes, on having a strategy for optimization. It feels like that gets overlooked sometimes in the rush of finding a great property.
It's crucial, though. Taxes, they can make or break your overall returns, so you got to factor them into your models. Kizzy's got some really solid advice on this, like understanding how depreciation can work in your favor.
Depreciation, yeah, that one's always been a bit of a head scratcher for me.
It's a powerful tool, though, for investors. Basically, it lets you deduct a chunk of the property's value each year for wear and tear, even if the property itself is going up in value.
Hold on, so I can take these depreciation deductions from my rental income, even though I'm not actually spending that money.
That's the idea. It can seriously lower your tax bill and give your cash flow a nice boost. And Kizzy points out other tax-efficient strategies, like structuring your investments in a way that minimizes what you owe.
Like having a secret weapon to boost that bottom line. You know, I'm a sucker for a good story, and I have to ask, do you remember that story about Lisa, the investor who wasn't sold on financial modeling at first?
Oh, how could I forget Lisa? It's a cautionary tale, but it also shows how powerful these concepts are. She learned the hard way that ignoring the numbers can cost you, especially when the market throws a curveball.
She was all about going with her gut, relying on intuition. Then the market shifted, and suddenly she's in over her head. It's a good reminder that even the most experienced investors can benefit from a data-driven approach.
Absolutely. Lisa's story shows how important it is to get a handle on discounted cash flow analysis, or DCF. It's basically a way to figure out what an investment is worth today, based on what you think it'll earn in the future.
So DCF helps me answer the question, is this property really worth what I'm paying today based on how much income it might generate down the line?
You got it. Like looking into a crystal ball, but instead of vague predictions, you're using hard data and projections to figure out if it's a smart investment for the long haul.
Sounds incredibly useful, but how does someone without a finance degree wrap their head around DCF analysis? Seems pretty complicated.
It might sound intimidating, but the core concept is actually pretty straightforward. You're basically projecting the cash flows you think the property will generate and then discounting those cash flows back to what they're worth in today's money.
So it's similar to using the time value of money, figuring out what those future earnings are actually worth right now.
Precisely. And then you compare that present value to what you'd pay for the property today. That helps you determine if it's potentially a good investment opportunity.
It's like I'm finally understanding the language of my financial calculator.
Yeah.
Not just punching in numbers, but actually getting what they represent.
And that's the key takeaway here. It's not about blindly following formulas. It's about understanding what those numbers mean, how they reflect what's happening in the real estate world.
And speaking of the real world, something that really resonated with me was Kizzy's focus on having multiple exit strategies. It's easy to get caught up in the excitement of buying a property, thinking you'll hold on to it forever. But Kizzy encourages us to think beyond that initial purchase, right?
He's all about flexibility and property investment. Markets change, life throws you a curveball, and your financial goals. They change too. So instead of assuming you'll hold on to a property for a set amount of time, he's all about exploring those different exit scenarios.
Instead of just saying, all right, I'll sell this in 10 years, I should also be prepared for what if I need to sell sooner, or maybe hold on to it longer.
Exactly. Like, what if interest rates suddenly drop and refinancing makes more sense? Or a big company moves into the area, driving up property values? Thinking about those possibilities up front lets you adapt your strategy as you go.
It's like having a backup plan, or even a backup to the backup plan. You're not stuck on just one path, which is huge in real estate, with all its ups and downs. Yeah, before we wrap things up, one thing's been on my mind. This book, it focuses a lot on analyzing properties that are already out there. But what if you're thinking about building something new? Do those same principles apply?
Great question. The book doesn't get into new construction specifically, but those core financial modeling principles, they're still absolutely relevant. You're still going to analyze cash flow, understand the time value of money, and factor in those taxes and risks.
But instead of evaluating an existing property, you're basically creating a financial model from scratch.
Exactly. You'd factor in the cost of the land, construction expenses, permits, everything, and you'd account for how long it takes to build. It's definitely more complex, but the core ideas are the same.
So no matter what, whether you're buying a property or building one, understanding financial modeling is crucial. It's like having that extra edge to make smarter, more informed decisions. This whole deep dive has been eye-opening, really changed how I look at property investing.
That's fantastic to hear. It's all about empowering yourself with the knowledge and tools to navigate this market. And remember, it's not about tossing out your intuition. It's about refining it, giving it that solid backing of data-driven insights.
Measure twice, cut once, right? Well, I want to thank you for joining me on this journey into the world of property investment modeling. It's been a pleasure.
The pleasure was all mine. And to everyone listening, remember, knowledge is power, especially in real estate. So keep learning, keep exploring, and never be afraid to dive deep.